FX Nation, what's up guys? Welcome back to the channel. Welcome back to another video. And of course, welcome back to Trading with a Purpose. And in this particular video, this next episode, we're going to go ahead and break down the market maker cycles of specifically accumulation, manipulation, and distribution. Now, this is essentially main concept that we talk about when we look at the Asian, London, and New York session. What happens within those particular sessions? Now, a couple things that I want to make sure that everyone knows. This market maker cycle goes back a long time. And I mean, going back to like the 1930s. So this is not something new, okay? It's been around for a very long time. You may have heard different names for it, but the originator of this type of concepts goes all the way back to with the Wyckoff method. If you want to study Wyckoff method or Wyckoff's market cycle theory, you can look into that and you'll see same thing, just essentially different names that people have decided to change over time. So with that being said, if you're new to the channel, we're essentially doing a year-long program where we're following four pairs: pound USD, pound JPY, NAS 100, and gold. And we're following the entire year these four pairs to see how they actually trade within this particular method. All right, so hopefully you'll get a lot out of the video. If you're new to the channel, that's what we're doing. And if you want to follow along, join us in our Discord group. The links are in the description. So with that being said, let's get right into the video. So we're going to take a deep dive into one of the most critical concepts of the trading with market maker strategy, and that is the market maker cycles. Now, understanding these cycles will give you a powerful edge in the market by helping you recognizing key phases that dictate price action. So let's get right into it. Market maker cycles, what we'll cover today. Okay, we're going to break down the three main phases. We're going to get into accumulation, manipulation, and distribution, and show you exactly how to spot them in real time. By the end of this video, you will have the tools to identify these cycles on any chart and apply them to our trading strategy. This is a foundational lesson because knowing where the market is in its cycle can be the difference between a winning or losing trade. Let's go ahead and get started with this. Let's go ahead and start with understanding the market maker cycles. Market maker cycles are the natural fluctuations in price driven by institutional players or market makers. These phases shape market trends and movements, often causing price action to go against what retail traders expect. The market is often manipulated by large players to create confusion, trapping traders in the wrong positions. Now, the first phase is accumulation, where market makers are quietly building their positions without moving the market too much. This is followed by manipulation, where the market makers move price sharply to create false breakouts and trap traders. Finally, we reach the distribution, where the market makers unload their positions at higher prices before the market reverses. So understanding these cycles helps us identify high probability setups so we know when to enter and exit trades. Let's break down each of these phases in more detail. So let's start off with the accumulation phase. This is where it all begins. During this phase, market makers are slowly and quietly accumulating their positions without moving price too much. The price action here is typically range bound, and you might notice the market staying within a tight range for a long period. This is essentially the Asian session. Now, during accumulation, volume is usually low and the market doesn't show any clear directional trend. This can be frustrating for traders because it feels like the market is stuck and they're just eager to jump in. But as a trader who understands the cycle, this is actually the time to sit back and watch the market. One key characteristic of this phase is consolidation, price moving sideways. At the same time, you might spot divergence on momentum indicators like RSI or stochastics. This divergence can signal that the market is building up momentum for the next phase. The big mistake most traders make during this phase is jumping into trades too early, expecting the breakout to happen. But you need to be patient and wait for the cycle to complete before you make your move. So how to spot this obviously is look for consolidation and low volume. We're looking for bullish divergence, basically momentum. You can use, RSI, MACD, stochastics. Most traders that use this strategy specifically, we're going to be using the Traders Dynamic Index, and you'll see may show some divergences with price remaining flat. Mistakes to avoid, obviously jumping into trades too early during consolidation and assuming it is a breakout. Now, let me show you what this actually looks like on a chart. All right, so here we are on pound USD on a 15-minute chart. Here is the Asian range. This is Tuesday. So you could see essentially from the start of the Asian range here starts at 8 p.m. Eastern Standard Time, and it runs through about 1 o'clock in the morning. So for this particular range, you can see where price action is just moving sideways, really not doing much of anything. But most importantly, you could see going further back, you can see that the price starts to consolidate more around about 5 o'clock in the afternoon. Now, if we add this line here, this line basically is the beginning of the new day, 1700. You can see really this is where the consolidation starts to begin and pretty much does nothing for the entire Asian session. Now, of course, you're going to have pairs like pound JPY that do move actually quite a lot during the Asian session because it's a JPY pair. So of course you would expect movements in those particular markets. But for most pairs that don't trade during the Asian session, you're going to see a lot of this sideways movement, market makers just moving sideways and collecting orders. You can see the range is only about 20 pips. Again, you can go back previous day, pound USD, same thing. From the end of the day, you can see price just starts to consolidate. It's about a 20 pip range. This happens over and over and over and over again. Here's another range for day before. Again, start of the day, you can see 29 pip range, and it's just consolidation. That's all this is. That's all the accumulation phases is just consolidation. That's it. Okay, just think about it like that. It's just consolidation that happens during the Asian session. Here is pound JPY, again, consolidation throughout the Asian period. You can see though that the ADR is quite higher on pound JPY, just the pip value is a lot more on this pair. But the Asian range is about 46 pips on this one. But again, same characteristics, just moving sideways, consolidation. Same thing here, previous day, you could see consolidation. Asian session, this one is about 81 pips just because of the big move that happened right before 8 o'clock. Again, you will see this particular pair does have sometimes moves that happened during the Asian session, mostly because of news. Again, here's another day, 62 pip range on this one, but it's same scenario, just consolidation before the London session. This is what we ideally want to see. There are going to be times though whenever you see this range, what we like to call completely blown out, where it's just so much because of news. So here would be an example of a session that's just blown out because of news. Literally, you could see consolidation, news hits, you get the big candle, and then retraces immediately, goes back into consolidation. So the majority of the time during the Asian session, when you see this behavior, it's literally just news. But you could see for the majority of the time, it's mostly going to be consolidation. It's very simple, very easy to understand. That's all the accumulation phase is. It's just consolidation during the Asian session. All right, so next up, we have the manipulation phase. This is where market makers take price and manipulate it sharply, often in the opposite direction of the trend to trap retail traders. The purpose of this phase is simple. Get retail traders to take positions in the wrong direction, triggering their stops and filling the market maker's orders at a more favorable price. That's all it is. So during manipulation, you'll see sharp price movements, often in the form of false breakouts, or what I like to call stop hunts. These sudden moves will often reverse quickly, making it seem like the market is reversing when in fact it is just a trap. It's crucial to recognize when manipulation is happening so that you don't get caught in the fake moves. So fear of missing out, or FOMO, is one of the most dangerous emotions you could have as a trader. You might be tempted to jump in during a sharp breakout, but remember, wait for confirmation. Don't chase the move. So a good way to spot manipulation is to look for candlestick patterns like pin bars and golfing candles that signal price is about to reverse after a sharp move. If you see these after breakout, that's your signal to stay out of the trade. So mistakes to avoid: obviously chasing moves before proper confirmation, ignoring market structure, and waiting for proper signals. All right, let me show you what that manipulation phase actually looks like next. All right, so here we have just literally the same chart we were just looking at, and then here's the London session. Okay, notice essentially what happens towards the bottom of the London session. Okay, price aggressively starts to move down at the bottom of the London session. Now you have to understand what you're looking at. Well, think about this. If you're a trader, right? If you're a trader that is trading, let's say, breakouts, right? Where are you likely to place buy stops or sell stop orders, right? If you're a breakout trader looking to put, looking for sells, let's say, well, you're going to put sell stop orders right below these Asian lows. Same thing if you're a buyer, if you're a breakout buyer, you're going to put buy stop orders above the Asian high. This is where the manipulation happens. These are the orders that market makers are looking for. Okay, so in this case here, you could essentially see that market makers this time were hunting for sell side orders, okay, sell stops. They were hunting for that because they went down and grabbed these orders. Now I want you to pay attention to essentially what happens once they grab those orders. You see, they move away. This right here, this area is the manipulation. Here is another example of manipulation. Again, you have the Asian session, and then you have market makers right here grabbing orders. This time they're grabbing all of the buy stop orders that are sitting up here. Again, you can tell that because they're staying literally at this level over and over and over again. Now, a common thing that happens in this area while they're doing this is you're going to have the spread actually open. Okay, so in this area here, you might think that price only went up to this area, but in reality, that's where the actual bid and ask opened up. So if you ever have the bid and ask on your chart, basically there are two lines that are separated. One is the ask, one is the buy price. You'll see when they get up into this area here, it'll get really separated, right? And that spread essentially opens and closes like this, and it just allows them to grab more orders. So if they're up here, if they're down here, the spread may be like this, the two lines. But as they get up higher, you'll see the spread open. And as it opens, it just allows them to grab more orders. That's all. Now, the worst kind of manipulation happens when they tag both buy side and sell side at the same time. You can essentially see here that once we get out of the range, we immediately start to attack all of the sell orders that are sitting here. You can clearly see what's happening, the manipulation that's happening, and then we move up. Now, they're not done yet though, because they want also the buy side as well, right? This is why you could see all of these wicks. This is all grabbing orders. Same concept. You have the two, the ask and the bid here dragging along, and then they're grabbing all of these orders as the spread gets bigger into these areas. So by the time it's up here, the spread could be open by another 5 to 10 pips. They're really trying to clear as many orders as possible before they actually move in their intended direction. Okay, so in this example here, you can see the manipulation essentially happens on both sides during the same session. Here's another example. Again, manipulation. This time they're grabbing the orders at the top, and you can see what happens. As soon as they have what they need, okay, you get a nice railroad track, and then price continues to go down. So this right here is the manipulation. You can look at any chart on any pair and you'll see the same thing over and over and over again. It's there every single day. Here again, there's your Asian range, and then the manipulation happens right here, 2 bars on a 15-minute chart. They get the orders. Once they have enough, that's when they aggressively move out. These traders here that were selling are trapped, and then now they're just taken for the ride. All right, so now let's go ahead and talk about the distribution phase. Now, this is where essentially market makers start to unload their positions at higher prices, preparing for the next move, which is typically a reversal. After the manipulation phase, price will reach a high resistance level and buying pressure starts to ease. Same thing happens on the sell side. Now in distribution, you'll notice that price is struggling to move higher. It will form lower highs and start showing exhaustion. Momentum indicators like RSI will start to show divergence, indicating that the market's momentum is weakening, even though price is still rising. This is the phase where the large players exit their positions. If you can spot the signs of distribution early, you can trade the upcoming reversal with the high probability. The mistake traders make here is thinking that the trend will continue just because price is at the top. But remember, distribution is a sign that market is preparing to reverse. So buying during the final stages of distribution phase, expecting a trend to continue, and failing to recognize the signs of the distribution early enough for a reversal trade are mistakes to avoid. Now let me show you what that looks like again. So here, same example, you can see the distribution that happens. All right, we have the accumulation right here, the manipulation here, and the distribution there. That's it. That's all it is. Okay, this is all that we're talking about. And you'll see this pretty much every day on different pairs. Here's an example here. Here's the accumulation, here's the manipulation, and then here's the distribution. Get people stuck in trades here, comes back, retest these lows again, get orders that are sitting here. One thing you have to understand, okay, is that when the market is consolidating, it doesn't matter where it's at. When there's consolidation, okay, there's going to be orders that are sitting above and below. So above this here are going to be orders, below this here are going to be orders. Just like above this here is going to be orders and below that is going to be orders. Anytime that there's consolidation, movement sideways, there's always going to be orders on top and on the bottom. Again, so here's the accumulation, here's the manipulation right here, and then here's the distribution. This is essentially the trade, right? This is right here, the distribution is the trade. I mean, this is the day before. So same thing, accumulation, manipulation here, and then distribution. Again, this right here, this entire move, that's the trade. Now let's talk about applying the cycles to your trading. The key to success is understanding where the market is in its cycle and acting accordingly. So first, identify accumulation. Look for tight ranges and low volatility. When you spot these phases, be patient and wait for a breakout confirmation. Next, watch for the manipulation. This is where price moves sharply, trying to trap traders. Don't jump in too soon. Wait for a reversal or a clear price pattern. Finally, trade the distribution. Once you see the signs of distribution, like exhaustion, divergence, get ready to take the trade reversal. You can apply these three phases to any time frame. The key is to be patient and to wait for the market to unfold. Use price action signals and candlestick patterns to confirm your entry. Identify the cycle, wait for the confirmation, and place your entry. When you keep it simple like that, all you need. Now, building your trading plan. Here are some key questions to ask yourself. Okay, where is the market in its cycle? What are the key support and resistance levels? Do I see clear signs of the accumulation, manipulation, and distribution? Now, something very simple that you can do is just create a checklist. Create a checklist for identifying phases. If you're new to this, this is the simplest way to do it. So check for key levels and liquidity zones. Wait for confirmation before entering. By tracking this consistently, you'll develop the ability to predict where the market is going and trade accordingly. The cool thing about the strategy that I use is that it's very simple once you have your directional bias, because the patterns that we trade for are solely based on the directional bias that you have. So if you're looking for sells, let's say on pound USD, based on what price action is, I can pretty much tell you what pattern you should be looking for. And if that pattern doesn't happen, then there is no trade setup. Okay. Now the cool thing is, as well as you can see with our indicators, essentially it makes identifying these accumulation, manipulation, distribution pretty simple, because it's boxing out where the consolidation is happening. I hope you enjoyed this particular video. This is a very simple understanding of the accumulation, manipulation, and distribution phases of what happens basically from the Asian session into the London session. All right, so hopefully you got a lot out of this video, guys. Do me a favor, join our Discord community so we can talk about it. Like and share the content, and we will see you in the next one.